Today I'm excited to be here with an industry veteran who needs no introduction. He has spent more than 25 years in the financial space navigating markets, and someone who calls himself a student of the market even today. It gives me great pleasure to welcome Nilesh Shah, Managing Director of Kotak AMC, with me on this dialogue. Welcome Nilesh bhai.
Thank you.
Nilesh sir, we have three important deals that came in: the US FTA, the EU FTA, and the recently concluded budget. How do you think that these events have been able to shape India's economic narrative and our positioning on the global stage?
So undoubtedly, India is now upgrading its growth orbit. Earlier, we were growing at a 6.5% sustainable growth rate. Now, economic survey projects that to go to 7%. I think India is still punching below its potential, which is probably double digit. But fair enough, to go from 6.5 to 10, you first have to cross 7. This budget is the first budget where capital expenditure at 12,10,000 crore is more than the net market borrowing of 11,70,000 crore. The gap was narrowing over the years, but this is the first inflection. हम अपने बच्चों की आंख में आंख डाल के कह पाएंगे कि बेटा तेरे लिए 12,10,000 करोड़ का असेट छोड़ जा रहे हैं और 11,70,000 करोड़ का कर्जा छोड़ जा रहे हैं. हम तुम्हारा भविष्य गिरवी रख के अपना वर्तमान नहीं बनाएंगे. I think the budget deserves kudos only for allowing us to make that statement. Now comes the FTA. EU FTA is negotiated, waiting for approval. US FTA is approved, but waiting for negotiation. But I'll give you a simple example. We are the largest grower of cotton in the world in top 3 rankings. We have the largest spinning capacity. We make all kinds of yarn, man-made cotton, natural. We also weave that into fabric. But when it comes to garment exporting, अपनी गाड़ी गुल हो जाती है. Our exports to European Union is about $7 billion of garments. Bangladesh is at 30 billion. China is at 50 billion. Why is Bangladesh outperforming India? They have zero import duty. We have 12% import duty. Hopefully, if by Diwali this EU FTA gets approved, ratified by European Parliament, maybe 1st Jan 2027, Indian exports of garment to EU will be at 0%. Then we will be at a level playing field vis-a-vis Bangladesh. The garment exports can take off. The same will happen in aquaculture, handicraft, gem and jewelry, and so many other things. So this growth orbit changing from 6.5 to 7 and beyond is culmination of the 2 FTAs and the budget which we have done.
Thank you, Nilesh bhai. From a fund manager's perspective, what is the single most takeaway for investors from this confluence of the trade deal and the budget announcement?
The only learning, never try to time the market. Time in the market makes money for you, not trying to time the market. On Monday and Tuesday, markets are up about 4%. That may be next 6 months' return. If you are trying to time the market, you won't be able to make money. It's better to stay on the pitch without scoring run. Like in September 24 to Jan 25, Nifty 0 return, Jan 26 0 return. But if you stayed there on 1st and 2nd and 3rd Feb, you made 4% return. So never trying to time the market, invest karo and stay invested.
You have often emphasized that the devil is in his detail. As with regards to the EU deal, do you think that India has been able to safeguard its domestic sector while trying to gain favorable access to the European Union? And has this deal made a significant impact on the economic growth for us? What is your view on this?
Undoubtedly, India in a way is like Hanumanji. It is said in Ramayana that Hanumanji was very naughty in the childhood. And that's why he was cursed that he will forget his powers. And when he was standing at the seashore to jump into Lanka, he was worried whether he'll be able to jump or not. And then Jambavant came and told Hanumanji that Hanumanji, you have all the power, just remember and jump and you will reach your destination. As I mentioned earlier, Bangladesh exports $30 billion of garment to EU. What EU can export to Bangladesh? It's a small country. Maharashtra may have a bigger market GDP than Bangladesh. But we never leverage our domestic market from an excess point of view. We always believed in Atithi Devo Bhava. We always welcome foreign investment without asking reciprocity. Now in this FTA, we are leveraging access to our domestic market. We'll give preferential treatment provided you give us preferential treatment. Otherwise, तो वो treatment हम वैसे ही देते थे. So if we leverage this FTA, I think there is much better opportunity from export point of view in textiles, in aquaculture, in chemicals, in handicrafts, in gem and jewelry. Collectively, they don't contribute much to the export, but look at the employment they create. Even today, after construction, textile has the second largest employment of workforce.
Thank you, Nilesh Bhai. The US trade deal has seen tariffs drop from 50% to about 15%. Right? Do you think that this is going to revive the capex cycle for Indian export-oriented businesses?
We'll have to wait how the details emerge in US FTA. As of today, it's an agreement that tariffs will drop to 18%. But there are certain segments where tariffs were zero. There are certain segments where tariffs may not drop to 18%. And then there is a whole host of where tariffs will drop. I think people would like to have more clarity before they will take a call. Private investment is subdued undoubtedly. The Tatas, the Birlas, the Jindals, the Ambanis, the Adanis, they are spending. It is the small and medium enterprises where there is a worry. And I think this is where we need ease of doing business. The Jan Vishwas 1 bill, Jan Vishwas 2 bill, these are on step in right direction. But the asking run rate is on the higher side. I recently went to Pune and I had read someone's tweet that in Pune in a floor mill, the owner had displayed 15 approvals, photo framed. And I was just chatting with a mutual fund distributor and he said, Nilesh bhai, हमारे area में ही आपको चाहिए तो दिखा देता हूँ. And I just wanted to see that out of curiosity. Is those 15 approval real? And yes, it was real. For running a floor mill, you need 15 approvals. That's not ease of doing business. The day that will be reduced, I think investments will take off.
The ratification of the EU deal could take about 6 to 12 months because it needs to be signed by the member states. Do you think this is going to cause some kind of indifference in the market because of this lag effect? Do you think the market has been able to price that in?
Market has priced that in because it is very well known. If at all, I believe EU will surprise us, hopefully with speed. They can take advantage of AI, convert this hundreds of pages into whichever language they want via AI. And I'm sure they'll be able to take some via media way, whereby the process could move faster.
You mentioned that the capital expenditure now currently exceeds the net market borrowing. Do you think this is a watershed moment for the Indian economy? And what signal does it send to global rating agencies and FIIs?
So global rating agencies have their name. Our standards are poor and we are moody. I don't think so we can expect any fair dealings from their side. India is one of the few emerging market country where the net FX reserve is more than the net FX debt. If from my total FX debt I remove the NRIs, which generally gets rolled over, I have more FX reserves than FX debt. Rating agencies are telling us that a company or a country which has more cash on balance sheet than its debt is not investment grade. How can you believe it? So ignore the rating agencies because markets anyway are not pricing India credit based on what rating has been assigned to us. Our credit spread is in a far higher rating category. One day standards will change. they'll become fair, and mood will also change.
The government is now aiming for a 50% debt to GDP ratio by FY31. Do you think it's a realistic expectation from the government? And what do you think are the market expectations with regards to India's fiscal prudence going forward?
So undoubtedly the biggest achievement of this administration is fiscal prudence. India is the only major economy in the world which has reduced its debt to GDP ratio between subprime crisis in 2008 to post-COVID crisis in 2025. No other country has been able to do it. We have done it courtesy our households which are deleveraging and our corporate which are deleveraging. The government of India to fund COVID expenditure has borrowed money. Now government is deleveraging. Imagine a country where corporate, household and government all are deleveraging. That's definitely step in the right direction. But at the same time we have to ensure that government does not deleverage unnecessarily. There are areas which require investment. Like in this budget, we are saying 20,000 crore for carbon capture, 10,000 crore for biosimilar, 10,000 crore for SME fund. Last budget, we talked about 1 lakh crore for research development initiative, innovation fund. These are the areas where we have to invest. If government borrows, let's say, 50,000 crore more to set up a Bharat GPT, maybe it's worth taking the risk. So don't go for fiscal prudence at the cost of future investment. India must have a place on the table on futuristic investment.
Currently, the hike in the STT is something that people are talking about. Do you genuinely believe that this sin tax is kind of get retail investors to move to long term? Or do you believe that this is just going to create an inflationary moment in the market where there is going to impact market liquidity as well as there is going to be an increase in hedging costs?
I wish I had the answer. Head tells कि भाई टोबैको के ऊपर सिगरेट के ऊपर टैक्स बढ़ा दो तो स्मोकिंग करना छोड़ दे, वैसा नहीं होता. The heart tells that if you keep on increasing tax, there is illegal cigarette making and smuggling which gets encouraged. ऊंट की पीठ पे तिनका, the last straw on the back of camel. If the cost of trading on official exchanges increases, in today's world, dabba trading will prevail. I think while the intention of finance minister is absolutely right, that I don't want retail investors to lose money. SEBI studies have shown 9 out of 10 speculators lose money on derivatives. Maybe the methodology we have to be careful. If you keep on increasing STT, people will go to dabba trading. Maybe we should have entrance exam for people to pass so that they are qualified enough to play in the derivatives market. That way, cost of doing transaction remains under control, liquidity is not impacted, and the battle in the market on derivatives is between equals. So, I will say, ऊंट की पीठ पे ज़्यादा तिनका मत डालो, ऊंट बैठ जाएगा.
Wonderful. I think in your famous Amar Akbar Anthony analogy, do you think there are some sectors that have moved from Anthony, which is expensive, to Amar right now, which is value based, with this current budget announcement as well as the trade deals?
So there is one announcement in the budget which says that we'll monetize public sector enterprises lend via REIT kind of structure. There are so many PSUs where the real estate value is more than the market cap. If those can be monetized, undoubtedly those values will get unlocked. Second, the EU and US FTA, it is really a growth opportunity. I'll give you a small example. India is blessed to be in that middle range of temperature. We are neither too cold, except maybe in mountains, and we are not too very hot either. Aquaculture grows in that middle temperate water. Our aquaculture exports are about $8 billion. I think with this FTAs, there is potential for this aquaculture exports to grow over next decade to some $30 billion. We have the geographical advantage. Will we go and explore that opportunity? If we do that, suddenly aquaculture becomes a value sector. Same thing in textiles, same thing in chemicals. They will become value provided we capture the growth opportunities unleashed by these two FTAs.
Do you believe that the trade deals have cushioned the pressure on the rupee? And if so, does it kind of give the regulator a little more leg room to kind of have a accommodative approach? And if yes, then do you feel that the BFSI sector will stand to benefit with this change?
So rupee is still under pressure. The market knows that RBI is running short between 60 to 70 billion dollar. The reserve accretion in recent year is because of gold appreciation and rupee depreciations against yen, euro and renminbi. So rupee remains under pressure. And fortunately for us, this time pressure is not on current account deficit. Thanks to GCC services income, we are balanced on the current account. It's the balance of payment which is negative for 2 years in a row. Companies like LG, Hyundai, Prudential, Whirlpool, they are taking money out. They are taking money out to such an extent that gross FDI of $80 billion on net becomes zero. Now, my feeling is that what happens on capital account will determine what happens to rupee. The destiny of rupee is to depreciate because our inflation and our productivity both are adverse to our partners. 2 to 4% depreciation of rupee is likely to occur. We need some divine help on balance of payment flows coming either from American institutional investors or European institutional investors post these two FTAs to take out the pressure on rupee.
Modern FTAs now include digital trade chapters. How does this evolve the outlook for the Indian IT services, especially given the recent trust deficit and the currency volatility? Where should investors look for in opportunities in this space?
So on IT, we are as confused as retail investors after Anthropic revealed that here is an AI tool to help you read through your lawyer's bill and legal documents. The speed at which AI is jumping or progressing is truly unbelievable. It's going to disrupt Indian IT companies' model for sure. Now, today, in some sense, this is what we have seen in the past. The 2G, 3G, 4G, 5G telecom equipments network came. You made far more money playing telecom companies like Bharti or Jio than playing the telecom equipment maker. In India, we have very few telecom equipment maker, but whosoever is available vis-a-vis telecom company per se have done well. Now, will we see more and more Indian IT company migrating to leveraging AIs to deliver solutions to customers? From IIT BHU, a student has created Luna, a voice AI bot, which is closest to the human voice and emotive in appeal. It got replicated by another company and they named it Maya 1. So these are the kind of companies which will leverage AI to deliver solutions and world will demand it. Now if it can be backed by credibility of our large institutional IT companies, certainly there is opportunity for them. As I said, I'm as confused as retail investors. We are also studying everything and trying to understand what's happening. So far, none of the big contracts has been cancelled, but that could be just a precursor. So be nimble, wait and watch, and invest in companies which will be like the telecom companies who will leverage the telecom network and 2G, 3G, 4G, 5G technology to provide services to their customers, which is faster, better and cheaper.
The budget pushes for toll manufacturing with a 5-year tax exemption. It aims to revive 200 legacy industrial clusters and also has provided large focus to the semiconductor mission. Do you think that India can successfully run this multi-track industrial policy without spreading itself too thin? And what does it mean for manufacturing focused portfolios?
So today we are fifth largest manufacturer, overtaking South Korea, France. We are just behind Germany and Japan. Of course, the gorillas are US and China. The manufacturing contribution to our GDP has remained under 25%. And today, manufacturing is constrained by two things. One, higher logistics cost. Second, higher power cost. Power cost is high because agriculture power subsidy is loaded into industrial power. Logistics cost is high because passenger fare subsidy is loaded into industrial freight. We are trying to do bandage treatment by improving efficiency in logistics under Project Gati Sakti. But we are not following what Peshwa Balaji Bajirao say, strike at the root of the tree and the whole tree will collapse. You shift agriculture power subsidy into budget, you shift passenger fare subsidy into the budget, suddenly Indian manufacturing becomes competitive. Now you can't do it in one budget for sure, but can we give a roadmap of 5 years, 7 years? If that happens, then my entrepreneur knows that yes, tomorrow this cost will get normalized, I'll be competitive to the world. I think Indian manufacturing requires this kind of effort. Till such time, it is the individual brilliance. It could come in large sector like two-wheelers where Bajaj, Hero, Suzuki, TVS and Eicher has done a great job. Or it can come in an entrepreneurial spirit in Morbi town where tile manufacturers have defeated China even in European market. So either we rely upon individual brilliance, the two-wheelers, the tiles model, or we go and strike at the root of our manufacturing uncompetitiveness, agriculture subsidies and agriculture power subsidies and passenger fare subsidies.
As a part of the US FDA deal, India is committed to buy $500 billion of energy from the US. As a fund manager, how do you review this trade-off? Does it guarantee long-term energy protection for our own industries?
I think these are all statements. We have to wait for details. I doubt India under Prime Minister Narendra Modi will compromise its security. If we wanted to compromise our security, trade deal probably would have happened much earlier. There will be give and take, but certainly we are not going to give our autonomy.
The China 1+1 narrative is strong. Are these comprehensive trade deals and budget incentives truly enabling India to walk the talk and become a global manufacturing hub? Do you think our land and labor policies are well poised to be able to augment this growth?
Again, I'm not 100% sure. My head says China is way ahead and there is no way we can catch up. There is this technology called LiDAR technology, light detection and ranging. It's used in autonomous vehicle. The first LiDAR technology in Western world appeared at $75,000 per car. The LiDAR technology were most costly than car. Today, Chinese companies are giving LiDAR technology. The price is $100. From $75,000, they have brought it down to $100. How are we going to compete with them? Acharya Vishnugupta Chanakya wrote Sam Dam Dand Bhed. We are not reading Acharya Vishnugupta. Chinese have read it and implementing it. So head says, China way ahead, you can't compete with them. The heart says, look, in two-wheeler industry and tiles industry, we have defeated them. If Indians get their act together, if we empower our entrepreneurs, maybe there will be few more sectors where we'll compete with China. I think chemical sector is one sector where Indian companies today are struggling against China. But as they say, when time becomes tough, the tough gets going. So the tough chemical companies will probably script the same success story against China. Now, whether head is right or heart is right, I don't know. There are individual brilliances undoubtedly, but collective brilliance is missing. A Kapil Dev Nikhanj can inspire a bunch of players to go and win the Prudential World Cup in 1983. But finally, you require a team under like Mahindra Singh Dhoni, with players which can consistently win. Today I will say we are still 83 World Cup cricket team. We can once in a while win World Cup, but we are unlikely to sustain it.
With Nifty at its peak right now, given the whole tailwinds that we have, what advice would you give retail investors who want to capitalize on these FTA themes, as you call it, and budget announcement without falling into a speculative trap?
So I will say, follow the dharma of asset allocation. The speed at which events are happening, it's difficult to anticipate or predict or plan according to that. It's important that you buy when markets are cheap and sell when markets are expensive. And it's important that you are diversified so that you have opportunity to change your portfolio. So my recommendation, follow asset allocation, don't chase momentum, invest for long term, and time in the market will make money for you, not timing the market. If you get good entrepreneurs, just stay with them. No matter what happens in the world, they will create value over a period of time.
Our last section, a few rapid fire questions for you. Which sectors are you bullish on?
Over next 12 to 18 month horizon, we are bullish on consumer discretionary. Government has put money in pockets of consumers. They will go and spend. Those sectors will do well. Banks' margins are likely to expand post March 26 results. Market discounts things early. Cement, the GST was 28%, brought down to 18%, shared entirely with consumers. Eventually something will get clawed back. So these are the sectors where we are bullish.
If you had to choose for one reform in exchange of a favorable tariff, which reform would you choose?
Ease of doing business. Let there be a ease of doing business board, just like SEBI. Any entrepreneur calling them with his problem, her problem, they should be able to solve.
Finally, precious metals, equities, or both? What do you think will work in client portfolios in the next 12 to 15 months?
I think both are needed. There are so many events which are happening which can propel either one of them. So I will say, follow the dharma of asset allocation. Keep debt, equity and precious metal in your portfolio.
Thank you, Nilesh Bhai. We had a great time having this dialogue with you. Thank you for your valuable insights. It was a pleasure to have you with us.
Thank you.
Have a nice
day. And DBS for having me over here.
Thank you so much. Thank you everyone for listening in.